My name is John Bellamy. Thanks so much for having me this afternoon. I'm with a company called LVP, formerly known as London Venture Partners. We're a venture capital fund. I'll come on to a little bit about who we are and what we do shortly, but this is us. Talk a little bit today about VC in games. So venture capital in games. Talk a little bit about what, when, why, and how to raise VC. So this is us. We're a games fund. We exclusively invest in games. This is the third fund, second under the LVP name. We've been doing this for about 10 years as a group, and we only invest in the games ecosystem. We invest at the seed stage, so this is going to be frightfully pedantic for anybody who's raised funding before, but for anybody else, hopefully it's a bit interesting. What seed means, but basically very early money. And we're a team of games people, so we all come from operating backgrounds in game studios. Me personally, I came from Jagex up in Cambridge. I spent a couple of fantastic years there working on deals with that company. Else in the company has worked at other games co's before this. One of the general partners was employee number 11 at EA, set up EA Europe, was COO for EA for a long time, ran Atari for a while. Another one founded Criterion, which if anybody AAA games in here, obviously you'll know that company. And within the team, we've done just about everything you can do with a games co, from founding to winding up to selling to buying to listing in China, in fact, games companies, and now obviously investing. So this is part of our portfolio. This is the second to last humble brag slide. We've created about $14.3 billion in shareholder value so far by investing in games companies, the biggest of which probably Supercell, Playfish, amongst others. And so I came here today because I took an interesting observation away from three of the events I attended last year. The three that I'm talking about here are EGX, Nordic Game, and Barcelona Games World. So while I was there, I took a load of the data that we got from people that basically requested meetings with me and what kind of finance they were looking to raise. 89% of the people that came and asked to meet with me were looking to raise project finance, a bit like you might go to a publisher with and say, look, here's a game that I'm working on. We'd love for you to help us finish it with a bit of money and some expertise, maybe some distribution. 26% came looking for equity investment. 5% were lost. 6%, that was the number I wanted to focus on. I didn't really understand why only 1 in 4 people that basically wanted to raise money to build a studio had even considered this, or at least were open to the idea of meeting somebody to talk about it. And that was me. So early stage venture deals have been on the up for as long as we can track data, basically. And Europe is absolutely no small player in that. Roughly 48% of all the deals in the Western world come through Europe. So clearly there's something not quite right there. So I spoke with some of the founders in our portfolio. I also spoke with some entrepreneurs that I met at different events and some of my colleagues and came up with 3 hypotheses as to why this might be the case. Why do so few people have an active interest in pursuing equity financing? Number 1 was that it is opaque and inaccessible, so it's a bit of a black box, a bit mystic. The second was I just don't want to give away any of my company. Fair enough. And the last is I don't really know what venture capital is. And I think actually number 3 probably applies roughly to you as well. So I thought I'd start talking a little bit about what VC is. So it's quite simple. It's 3 consecutive processes, very largely. Number 1 is that a wonderful VC will come and invest in your company. So perhaps we buy into the shares in a company for $1 million. That way the startup gets $1 million of cash to spend to do what it does, and we take a small stake in the company. It's then in our interest and your interest to try and grow that company. So basically, as we grow the entire pie, it grows with it. And then by the time we get to the end of that funnel, we're in a position to exit our stake and probably the rest of the company. So that's when you're talking about M&A or maybe taking your company public. And so this is a very long flow, and this chart I've briefly put up here is representative very roughly of what a company kind of looks like in terms of profit or growth stage as you might look at different options, all the way from friends and family money up until the big private equity guys that might want to take your company public, a strategic stake in it. This is where we play. We're very, very early. No such thing as too early for LVP. So we'll come in right at the beginning. We've started companies with founders before, technically as joint ventures, but we'll also invest up to, say, $2 roughly in an early stage company. So I thought I'd talk a little bit about the differences between equity and project investment, just to really clarify why your pitch to a publisher might not be the same for a VC. Focus for us is really it's team potential versus project financiers will be looking at project potential. Obviously, they're buying a revenue share from that project, so they really want this to succeed. For us, I'd say we take a bit of a longer term view. So statistically speaking, it's first or even your second product that really hits the big leagues if it does hit. It'll be your third. It's roughly 2.3 products it takes on average. For us, the best way to ensure that product 3 does that is by investing in a team that's capable of hitting 3 excellent products and one of them being timed well. Like I said, project financiers will buy a revenue share or a profit share, so they'll buy part of the money that your game earns or perhaps subsequent games earn. For us, we buy a part of the company, so this is a very deep marriage. This is right at the cap table level with you guys. This is ownership. And when it comes to control, project financiers typically will look for IP control, not always the case, but that's probably the most common situation when project financiers come in looking for some level of control. For us, board is probably a little bit predatory. At least a board position is probably what we normally look for. So we can be right at the sort of front of that ship with the founders of that company and help making the big decisions that really will turn your company into something successful. And then when it comes to value add, project financiers, the really good ones, should be exceptional at go-to-market. It should be very good at taking a product that maybe is very nascent, very young, helping turn that into something more fleshed out, and then taking it to the world. For us, it's a little bit more holistic again. It's company growth. So it's not just product 1 or product 2 or product 3. It's not even necessarily company 1. We'll find that many of our repeat successful founders will come back to us and we'll do it all again. An ultimate priority, again, project success and company speaks for itself. One thing I will say, publishers or project financiers and VCs are not mutually exclusive. So there are situations in which it makes a huge amount of sense to have both, some less so. Okay, so when to winners need to win big. I'll come on to a little bit of why the math works for that, but really you need to be aiming for what I would call a moonshot, something extraordinarily ambitious, very, very high in potential scale, and it really tends to be a thing sort of situation. So quite often I'll be approached by people who say, look, we've got a super low risk proposition. It's less about risk and more about potential, so we really want you to be shooting for the stars. Without going too deep on this, because my colleague who just came in, Gavin, told me that I focus much on math. I'm sorry, that's me. Portfolio companies don't really follow a distribution that's a normal distribution, by which I mean if you were stacking up the size of all the companies in a portfolio, they typically wouldn't be roughly even, not even close. They actually follow power laws. The winners more than compensate for all of the, not losers, but less successful companies in a portfolio. So generally speaking, you'll find that I think a lot of major VCs aim for 30% of their companies to kind of return roughly the money that gets invested, and the top 30% to be really their outstanding winners that drive all of the performance of the fund. So I thought I'd talk a little bit about how we make money so it makes sense for you guys why we need to aim so big. So the timing could be very good if your market is growing and is large and has very high potential, which is often the case for games. So we think our business is a very good fit for games for that reason. You have an appetite to lead the market, or perhaps in a very, very large market, coming second could be great too. But generally speaking, we want you to build market leaders. You have for that, and you have to want that. And there's a very clearly presented path to scale. And I think one thing to clarify here is that it's not always the case that you have to want to build the next EA. That's absolutely fine. If you want to build exceptional games in an indie studio, that's unbelievably a goal. But it's probably not the best fit for VC, at least not for us. So why raise venture capital? So advice is one part of this, product market hiring, fundraising. These are the conventional things these will preach, but we genuinely like to be quite hands-on where required. So that means if you need help with hiring, there's probably somebody in our network that we can help you with, really add value in that way. Network, again, an extension of the previous point. So we have, as you'd expect, relationships with platforms, with your peers, competitors. So it can be quite useful to have somebody informed and contextually clued up on your cap table, on your board, to really help with making the decisions that maybe we have a different angle on. Fundraising, FOMO, or fear of missing out, is a $1 trillion industry. Generally speaking, if you raise a little bit of money from a really good VC, other VCs will take notice and say, actually, we like what these guys do, we respect them, therefore we'd quite like to invest as well. And that's suddenly where you find these runaway ventures where a company's tried to raise $2 million and eventually over 2 years raises 50. Recruitment, kind of what we talked about. Obviously, a lot of our portfolio companies have different needs, and so sometimes as they're winding up, we find great people from those companies to join other companies. Perhaps somebody wants to leave King, or, sorry, Todd, if you're in the room, or anybody else of that nature and wants to join a startup. We can absolutely help with that, and there's a good chance we'll know somebody. And then validation generally, it's a bit like the fundraising point. It's kind of a brand. Somebody who is well respected in the room invests in your company. It helps attract talent. It helps attract partners. It helps with generally selling your company. And then finally, at exit, as you'd expect, because like if you remember in that tree sort of slide, we find our exit at the same time you do. So really, it's in our interest to find the best possible outcome for you guys, because we win then as well. And that's what's so nice about this model, is that winners breed winners, generally speaking. So I thought some green flags and some red flags, things to do, things to avoid when you're pitching a VC, just for a few quick tips. I'll start on the negative. So conflicting obligations, and this is a big one. A lot of the guys in this room will have or will already be doing something higher work. And that's completely understandable. That's a very viable business model that's worked for people like Paddy and Chris at 4J Studios, who made all the console versions of Minecraft and did extraordinarily well. That's a really admirable business model. But if somebody's going money in you, it's very important that the objectives are clear and everybody's aligned, and making sure that the work being done is exactly the work being pitched. Over-promising, we know that Rome wasn't built in a week, and there'll be 6 guys in San Francisco that could promise me $1 billion empire by the end of next year. It just doesn't really happen that way, so be very realistic. No track record. It's very hard to understand the capability of a team without having seen what they've done before. Unclear and verbose, this is very much the pot calling the kettle black. But generally speaking, you're going to be selling to everybody. When you're hiring, you're selling your company. When you're selling your company, you're selling your company. When you're fundraising, you're selling your company. You always need to be selling, and if you can do that well and concisely, that makes the job a whole lot easier. And low market knowledge. Like I said, we really look for market leaders, people who want to lead the market, and it's very hard to do that unless you know the market in which you're trying to lead. And sloppiness. So raw is fine. I want to be very clear that if you come instead of white slides and say, look, this is what I want to build, super early, nothing polished, that's fine. You don't need a videographer or a PR team, but ultimately, spell your name correctly. And a product pitch as well. So if you come and say, look, this is my game, I really want to build it, can you help me build it? Maybe, but it's probably not what we would look for. Like I said, we really focus on finding exceptional teams that are the most qualified to solve the problems they're trying to solve. So absolutely, pitch your product. We need to know what you build. It's important, it's vital. But not just that. We need to hear about the team and the company. And then a fragmented cap table. So if you have 63 close friends, family, and angel investors that all own a small slice of your business, it's very hard for us to make sure that as you're going forwards, the founding team stays really incentivized and motivated. So for us, simplicity is very key at the early stage. It's a little bit more acceptable later on, but generally speaking, we like founders to own all of their company when we first start talking to them, or all of the company. Okay, so green flags. A clear vision, so something that you can concisely express. We want to take mid-core games to mobile and build an empire of people that used to play PC, no longer play mobile, a la Supercell. Exceptional fit. By this, I mean exceptional team is fit for the proposition in hand here. So it's very, very good to have an exceptional team of people who've built AAA games for the last years, but if you then pivot and say we're going to make a casino API for mobile games in China, it's very hard to understand why your team is the right fit for that. And a commercial acumen. So quite frequently, we are presented with some of the most exceptional creatives in the country, if not the world, being in games. But it's very important also that you have at least one person in the room who understands things like your unit economics. If you understand the value drivers behind your LTV and your CPIs, that goes a long way with us, exactly the kind of problems you need to optimize for if you're trying to scale a business. A warm introduction. So if you can get introduced to a VC by somebody that they respect, there's almost 100% chance that you'll have a good reception, or at least make of having an in-person meeting or something of that nature. So really, we're all reasonably well connected in the industry. It shouldn't be too hard to find somebody. If you can do that, it goes a long way. And battle scars, it's absolutely fine. In fact, it's good to have failed. Tried to start a company before and it's not gone well. Perhaps things wrapped up. If you've tried some other sort of entrepreneurial or adventurous or brave endeavor and it hasn't quite gone right, absolutely flaunt your scars, because those dollars that may have been wasted and those minutes or hours wasted on failing that time are minutes and hours that may not be needed again. So that's really attractive for somebody like me. And seasoned founders, obviously if you've raised money and you've built companies and sold them before, this pitch isn't for you. But if you've done something entrepreneurial before, or you've run another studio or owned a P&L at a big studio, I mean, that's very good seasoning. That's a great way to start a conversation. Obvious potential, if you can show me that the market that you're attacking is $18 billion, relatively untapped and growing at 50% per year, that's a pretty compelling narrative. And finally, competitive awareness. So really understanding who else you're competing against and why they're successful or why they're not, and why you will be successful despite them or because of them is critical. It's super, super important that you know your competitive environment better than we do, because ultimately they'll be looking at you if you're not looking at them. And thank you so much. It's been a short but snappy one. I really appreciate it. If you have any, please feel free.